Yes, thanks everyone for being here. Thanks to the organizers for including my paper into the program, and obviously thanks for organizing this amazing conference. The program has been very nice so far. I've learned a lot. There was like a very amazing papers on the program. I'm not sure whether I can live up to this standard. So this paper is called The Coming Battle of Digital Currencies. It's joint work with Will Song, and like if you abbreviate this paper, it also suggests what it's about. It's about CBDC. That's the abbreviation of the words here. So the paper is about CBDC, and to start with, note that we are kind of entering a new era of digital payments and digital currencies. For instance, in the past, we have observed the rise of private payment systems that operate outside of the traditional banking system. Examples of that are PayPal, M-Pesa, or Alipay. And clearly, there has been some regulations regarding these private payment systems. And a more recent phenomenon is the emergence of cryptocurrencies and decentralized finance. And one particular interesting part of that are so-called stable coins, which are a form of private money that have kind of grown important. They've risen, they've fallen, and they've at some point reached a market cap of about 100 billion US dollars. And more generally, all these developments regarding digital assets, digital finance, and digital currencies have attracted enormous attention from policymakers around the globe and politicians. To give you an example of that in the context of the US, on March 9th, 2022, President Biden signed an executive order on digital assets in which he essentially urged federal agencies to look more actively into the regulation of digital currencies, as well as the development of a so-called digital dollar, which would be an example of a central bank digital currency, CBDC. And more generally speaking, there is a growing interest among central bankers and policymakers in central bank digital currencies, and they are, as the title of this paper, abbreviated by CBDC. And to give you an idea about the state of CBDC initiatives around the globe, I have here compiled some picture from CBDC tracker.org, but like the BIS has even more detailed data about this. And simply the fact that most of this map is colored illustrates that most central banks around the globe are at least researching CBDC, and some are even a step further and have already developed a proof of concept or a pilot. And one particular large-scale pilot is undertaken in China right now, which is the Chinese e-renminbi or China's e-CNY. And interestingly, this large-scale pilot of a central bank digital currency in China has also triggered some discussions in the US of whether the digitization of the CNY could essentially undermine US dollar dominance and so on. And at this point, as we mentioned, obviously not all opinions in this debate reflected this view. But one example in this debate was like a popular news article by Ehrlich 2020, where the title is already self-explanatory what the author thinks about this topic, namely not a Cold War. China is using a digital currency insurgency to unseat the US dollar. And one development that got central banks really started to think about CBDC was essentially Facebook's Libra. Facebook's Libra was essentially the attempt by Facebook, as well as by a consortium of big tech companies, or at least tech companies, some are not big tech, to launch a large-scale private digital currency. And clearly, if this private digital currency had been adopted, it would undermine kind of the government's monopoly of money. So for these reasons, and potentially other reasons, Facebook's Libra was never realized, and in particular, it was never realized because it faced a lot of headwinds from regulators. But going forward, the possibility that at some point such a large-scale private digital currency might be launched, might be adopted, and might compete with government money gives certainly a preemptive motive for central banks to act right now and maybe to develop the CBDC or to digitize the currency. And generally, all of these developments give rise to many interesting questions. They also suggest that there might be a coming battle of digital currencies going forward, not necessarily now, but maybe in the future. And we can ask the several questions that are interesting to study. How is currency competition internationally affected? What are the trade-offs for governments or central banks to launch CBDC? And what is the role of all these developments regarding cryptocurrency, stable coins, and private payment systems in this regard? And generally, as economists, we would like to have a model that allows us to think about these questions or allows us to address some of them. And we take a first step in this direction. We propose a framework of currency competition in which countries' money, fiat money, competes with some digital currency, a simple stylized way. And notably, countries can endogenously upgrade their currency by digitizing it, for instance, by upgrading payment rails, or maybe by launching CBDC. And through the lens of the model, one can then conduct some kind of game theoretic analysis of countries' efforts, strategies of digitizing money. Let me give an overview of what we are doing. Essentially, this is a dynamic model of currency competition between two national currencies, A and B. And think of A as the strong currency in this context, or the dominant currency would be the US dollar in most of the cases. And B is a relatively weaker or at least non-dominant currency. And there's also a third player here, which is like one representative cryptocurrency. And we interpret this cryptocurrency broadly. It describes maybe stable coins. It describes maybe private payment systems that operate outside of the traditional banking system. At this point, we don't take a stance. And these three currencies fulfill the three functions of money in that they potentially serve as a store of value, medium of exchange, and unit of account function. In particular, the latter two functions are captured in reduced form by assuming that households derive some convenience by holding money. So it's money in the utility function. And one important feature is that the third player in this, the third currency, the cryptocurrency, is dynamically growing and adopted over time, thereby competing with these traditional fiat currencies. And the countries react to this growing competition by this cryptocurrency, by digitizing the currency, by upgrading it, i.e. by launching CBDC. And what are the main results in this framework? Well, first of all, there's some feedback effects in currency competition that imply some form of dollarization for the weakest currencies. Once you add cryptocurrency to this framework, then crypto is kind of a buffer zone between these two in the competition between these two national currencies and kind of mitigates the adverse dollarization for the weaker currencies. And countries, as I said, react to the growing competition from this cryptocurrency by digitizing the currency. In this context, we find that countries with non-dominant currencies, yet relatively strong currencies, can potentially gain a first mover advantage and have the highest incentives to launch CBDC early on. The next country in line, in terms of incentives to launch CBDC or to digitize the currency, is the country with the dominant currency. In this case, there's two types of motives that shape this country's incentives to launch CBDC. The one is a preemptive motive. If CBDC is launched early enough, then one crowds out the adoption of cryptocurrencies and nips the future growth of cryptocurrency in the bud, thereby precluding any competition in the future. And the second one is simply the motive reflecting unavoidable digitalization in the long run. And very weak countries with very weak currencies in this model do not have much incentives to digitize the currency. And the rise of cryptocurrencies in the model, generally speaking, both can be seen as a form of financial innovation as well as incentivizes financial innovation by the governments in that it pushes the governments to digitize the currency. And last, we also capture in reduced forms, we introduce in reduced form some role for stable coins, and this is simply reflecting that the US dollar has kind of become the effective unit of account in this crypto space. So if this crypto space expands, also the usage of the US dollar in this space implicitly expands. And in particular, this reduces disincentive for the US to digitize the currency because it already captures the sector via the unit of account function. In other words, stable coins or similar means could be seen as a digital dollar that is created by the private cryptos. Let me go into the model with skipping the literature. There's many important contributions, including many important contributions coming out of the ECB or the BIS. So this is an infinite horizon model in which time runs discretely with time increments denoted by dt. And this notation essentially suggests we take a continuous time limit once we have introduced the model. And there's one representative household that populates the economy and is endowed at any point in time with one unit of some perishable consumption good. And this consumption good is the numeraire. And you think of this household as a household populating the world economy. And this household kind of would like to consume late, but cannot store the endowment of the consumption good. So we need money as a store of value. And money comes, as I said, in the form of three currencies, namely currency A, which is the strong or dominant currency, currency B, which is a relatively weaker or non-dominant currency, and currency C, which is this private cryptocurrency, broadly describing also stable coins, private payment systems, and so on. And as I said, money serves as a store of value because the household would like to consume late, the overlapping generation household would like to store the endowment. But we also would like to account for potential other function of money, which is the unit of account function or the medium of exchange function, or that money simply provides some liquidity services. And we do so by assuming that the household derives some convenience yield from holding money. In other words, we embed money into the utility function. And to formalize this, we denote by mt to the power of x, the household's holdings of currency x at time t in terms of the consumption good. And because the household always stores the entire endowment, all these holdings add up to 1. The household derives some convenience from holding currency x, and this convenience is then characterized by a concave function b, as well as by some quantities, parameters pre-multiplying it set to the power of x. There's a concave function characterizing the convenience lead simply to capture that there's imperfect currency substitutability. Remember, the household should be interpreted as a world household. In this way, we simply capture that maybe some citizens in the US would like to hold dollars, whereas some citizens in Europe would like to hold euros. There's other features in the model, such as taxes or inflation, which reduce the consumption of the household. So a little bit when the household stores a little bit of its endowment in money, then something is gone due to inflation. I cannot explain this now in detail. There could be other features incorporated, such as risk premia, interest rates, and so on. So what does the household do? Well, this is the starting point of the analysis. The household is simply deciding which currencies to hold, trading off the convenience to holding a specific currency versus the appreciation of holding another currency or the relative inflation. And that leads then essentially to this equilibrium condition, which states that in equilibrium, the household is indifferent between substituting a marginal unit of currency from one currency to another one. What does it imply? Well, if currency A is more convenient, then the household substitutes toward currency A. If currency A is expected to appreciate relative to other currencies, then the household also goes to currency A. On the other hand, if the household thinks that cryptocurrency will appreciate in the future, then the household holds more cryptocurrency. When cryptocurrency becomes more adopted, it becomes more convenient. Again, then the household substitutes from traditional currency to cryptocurrency. And the appreciation and the inflation is kind of endogenous in this model. So let me explain the last two parts of the model, the last two ingredients. What is special about cryptocurrency? Well, you kind of assume that this is like some private currency that's over time growing and adopted. You might think that's not true. I looked and searched in the market was crashing. Well, this could be easily modified. We could also allow for crashes. We could also allow this sector to die. So this wouldn't be a problem. But for now, let's assume there's just some growing competition from cryptocurrency and some growing adoption. And what we stipulate here is simply that the more people adopt cryptocurrency today, the more convenient it becomes tomorrow. So the more people adopt it tomorrow, which implies then a higher price, feeding again back into households' decision to hold it today. And last part is we also assume that the US dollar is kind of the effective unit of account in that space, which implicitly implies that like part of the crypto market cap is backed by US dollar or US dollar equivalents. This is because for the US dollar to become the unit of account in the space, we need so-called stable coins, which are pegged to the US dollar and therefore are partially backed by US dollar assets. And that gives the US dollar some advantage. And this advantage is essentially characterized as market clearing condition on the bottom of the slide, which simply states that the value from currency A derives both from a direct demand for currency A from the household, as well as an indirect demand via the crypto sector. And this advantage, as we see, will then create some disincentives for the country A to digitize its currency because it wouldn't like to kill the crypto sector. So what is CBDC or what is currency digitization? Well, there's a huge debate about it. There's many excellent papers that tell you why we need CBDC. But there's also other papers that say essentially CBDC, I think a solution in search of a question, which is often told. Well, what we assume is CBDC must be something that increases the convenience to holding a specific currency. That could be maybe because it allows us to have electronic money that preserves privacy, as like nice work by Tony Arnott has shown. And could be also other reasons. It could also anchor the fiat currency, the digital world. There's many arguments put forward. We assume essentially that launching CBDC or digitizing the currency increases the convenience to holding a specific currency. How does it look here in our model? So every country X chooses some endogenous investment or effort to digitize the currency. And once it succeeds, the convenience to holding this specific currency jumps up. But we also assume kind of that there's some delay. You have to wait until you cannot immediately launch CBDC. It takes time. It's an R&D project. It's not possible to launch it from one day to the other. So there's some delay. And the more resources you expend, the faster you successfully launch CBDC. And now you might ask, what is the government is doing? There was like very illuminating paper earlier today talking about central bank objectives and how this depends on the governor's political ideology, or whether the governor's a hawk, a dove, or a pragmatist. Very interesting work. We have to endow kind of here the government or the central bank, which we use interchangeably with some objective. And all we assume here is that the central bank would like to maximize the adoption of its currency. You might say, wait, that's not what central banks do in the real world. They might maximize, they might essentially target price stability, or they might target financial stability. But what is underlying this objective is essentially, if you have your currency well adopted, then you might have it easier to target objectives such as price stability or financial stability. If on the other hand, your currency is not well adopted, or maybe foreign currency is used within your territory, then it might be difficult to achieve price stability. So in other words, the government or the central bank, this model maximize adoption, value, or strength of the currency. And wrapping up, it's essentially now a game between three players. One player is small, that's the cryptocurrency, and then two large players, which is currency A and B. And what is coming out of it? Well, the dynamics is that cryptocurrency is adopted over time. So in other words, why the convenience to holding cryptocurrency increases over time. That generates the dynamics in the model. And we transform Y here by L and Y, but like this graph essentially shows you how do countries react to the growing competition from cryptocurrency. So the first result is essentially that country B, which is the country with the non-dominant currency, has the higher incentives to issue CBDC to digitize the currency, as it can in this model gain a first mover advantage, because country A cannot immediately react. And then country A has like weaker incentives to launch CBDC, but there's some preemptive motive to launch CBDC early on, as this precludes for future competition from cryptocurrency. And I will essentially conclude almost with this slide. Well, what does this slide show? Well, panel A essentially shows you country B's incentives or resources expended to launch CBDC as a function of the relative weakness of its currency pi B, which I haven't introduced before. And this is essentially a hump-shaped curve, which simply states that country B's incentives to launch CBDC to digitize the currency are hump-shaped in its relative weakness of the currency. What does it mean? Well, countries with non-dominant but relatively strong currencies have the highest incentives to launch CBDC early on in this model, followed by countries with the dominant currency, followed by countries with very weak currencies. I think I'm running almost out of time. Would like to say that we can also then study whether launching CBDC as strategic substitutes or complements. That's interesting because it actually is kind of reflected in some debates. Here again, the article by Ehrlich 2020 in Forbes, but also Daryl Duffy has said something about it, who says essentially that, well, if another country launches CBDC, there's no need to react because US dollar dominance wouldn't be challenged by it. At this point, let me conclude. There's many developments regarding digital assets and digital currencies. A more recent phenomenon is essentially the growing interest in central bank digital currencies, in short CBDC, which is essentially an upgrade to fiat money. And to address questions regarding CBDC, how it affects currency competition, whether countries should launch it, we essentially introduce a model of dynamic currency competition with endogenous digitization, whereby countries' fiat currencies face growing competition from cryptocurrency. In this model, under specific assumptions, obviously, the country with the strong but non-dominant currencies have the highest incentives to launch CBDC early on, and countries with very weak currencies do not digitize. The digitization in this model becomes essentially unavoidable in the long run because cryptocurrency is some competition, but eventually the strong country might come out of this as a winner out of this battle. Would like to emphasize there's obviously some assumptions in the background. For instance, we assume that there's indeed growing competition from cryptocurrency, which might not be true, and that launching CBDC is actually an upgrade to a currency, which might not be true either. So this is like some assumption under which we work, but it's, I think, the first step in the direction. Thanks so much for the attention. Looking forward to the questions and very grateful that Jean-Charles has agreed to discuss this.
Thank you, Simon.